Okay, all right. Well, welcome to another edition of RockTalk. We are going to unpack kind of the wild world of money and markets and what's been going on here this last week. Today we're going to be talking about tariffs and how those tariffs tax imports and how they've been shaking up Wall Street a little bit. And, the market definitely bounced around this last week, and it's caused the most turbulent week that we've had in the market in the last 2 years. And I'll talk about that. I'll bring that up again here in a moment. But, looking back over a 2-year period. But so hopefully we can cut through some of the noise. We're going to dive into these 3 areas. We're going to talk about tariffs throwing punches at stocks here this last week. We're going to talk about alternative investments, how those are kind of sneaking their way into ETFs out there. And we're going to talk about some of the adjustments that we've made on our portfolio, bringing in some international exposure to, add in a little bit of secret sauce in there into that portfolio. And excited to dive into these 3 areas. And so the first one we're going to talk about tariffs. So I think a way to think about tariffs a little bit is think of it like maybe a bouncer at a bar or a restaurant that decides who gets to go in and who gets to pay a little extra to go in. And, and that's caused some, I think, uncertainty and volatility here in the market in the last week for sure. And tariffs affect supply chain. So I'm going to try to talk through this a little bit and try to keep things simple as we go through, but they affect supply chains. And if we think about it for a moment, like, if, let's say we slapped a tariff on steel, that might affect companies like Ford or Caterpillar. And when that happens, you see their stocks start to wobble. And because that causes uncertainty. And one of the things that we definitely saw this past week, there was a report that came out where these companies are seeing that tariffs are going to go up on those goods that we're importing. So what we saw was a big front running of companies going out and bringing goods into this country in the last month. And what that does is that hurts our GDP. Now, what's GDP? I'll give you hopefully a simple explanation. It's really a scoreboard for an economy. And what it does is it measures the total value of all the goods and services, all the transactions in that economy. So let's say cars that are produced, software that's developed and sold, even everything all the way down to us getting a haircut. So all the transactions in our economy, GDP measures all those goods and services within a country over a period of time. And we always want our GDP numbers to look good. And when you import a bunch of, in this case, let's say steel or whatever that may be, that's bad for GDP. And that can cause a recession, right? When we have multiple quarters back to back of negative GDP, that can cause a recession. So we've seen some volatility. And so, because of that, some uncertainty. And I've said this for years. Any of you that have been with us for a long time, one of the things I've said for a long time is that the market really dislikes uncertainty. Right? And if we look at the economy right now, one of the things that we're seeing, I do like the fact that Washington's being pretty open about and transparent about their communication, right? Or with their communication about what's going on, about what they're thinking about doing with Mexico or China or Canada. And 1 minute they're saying, we're going to tariff you, let's say 10% on energy or certain goods and services, but then through those negotiations that are going on, things change quickly. And so then we hear that...
Every 5 minutes, by the way, it feels like.
It's every 3. Yeah. Every 5. I mean, it's constant, right? So what we hear is, then we hear that, now we're putting a pause on a tariff. Maybe we're going to put a pause on it until April. Or maybe the tariff percentage changes. And so then what does the market do? The market, right? It bounces all over, right? And that's what we've seen. There's a lot of uncertainty, and the market doesn't like that. Right? So as things continue to move down the path here, we'll get more clarity, and that should settle the market down, but we're at the beginning of this, okay? So with that, I mentioned a moment ago that the market's been the most volatile here this last week that it has in 2 years, okay? So if we go back to March of 2023, anyone remember what happened in March of 2023? Nope. And that's my point, okay? At some point, we'll be past this down the road, and hopefully, this will be another blip, right? So to take you back to March of 2023, that was when Silicon Valley Bank failed, okay? The market dropped. There was some uncertainty, some worry at that point in time, but it bounced back and we were fine, right? Hopefully this will be another period like that where we have some uncertainty. Hopefully the market will bounce back and so forth. So when we're looking at the imports coming into this country, there's also which causes, so a tariff is a tax really on those goods coming in, okay? And what that should do is that should raise money for our government to pay down different debts or pay different things. But when we look at it, we've got this drop in the market going on right now, and we can see, if you look at that slide above, what is it saying? If you look at the top part that's blue, that is showing where the stock market ended up each year. And the majority of those years are positive. If you look at that gold or brown drop, that's down below it, that is the drop that occurred that year in the market. So what's going on right now is not normal, right? These drops that happen in the market, they are normal. It's just that at the time, it always feels like, we're going over the edge on the roller coaster and we're wondering, boy, are we dropping one flight or are we going 10 flights down? How far are we going? And no one truly knows, but we're going to get into it here in a little bit, and that's where designing a portfolio the right way should help to safeguard against that. And so when we look at these tariffs causing, it will cause probably an increase in some goods coming into this country. There's the flip side of that, where you also have some well-known brands here in the US, like, so if you take a company like Nike and Adidas, they manufacture most of their shoes over in Asia. So if there's a tariff on those shoes, you're going to pay a higher price to have a Nike or Adidas shoe. But then you take a company, the flip side, you take a company like New Balance. They have 5 manufacturing facilities on the East Coast. And one of the things, they have an entire line made in the USA. That's a company that would benefit from this type of situation where now their shoes will probably be purchased more, right? And so part of this tariff piece, as we all know, is part of it's to raise capital, tax dollars for the US to spend, the government, to maybe pay down our debt. Hopefully they spend it the right way, but also to bring jobs back to the US eventually, right? And also buy made in America and so forth, right? There's that ultimate, it does take some time to do that, but that's the path that we're heading towards. So implementing these tariffs, it's kind of like a game of poker. We'll see how good Trump and his team is at playing poker here as we move along, right? A lot of bluffs going on, and we'll see how all that plays out. So, in the last week, one of the positives that we've seen, and I'm going to hand it over to the two of you to talk through some more things here and hit on some points, but we have seen a drop in oil prices. We've seen a drop in interest rates. We've seen a drop in mortgage rates. We've seen a lot of, there's been a huge influx of new refinances going on out there in the mortgage area. So we're starting to see some positives in some areas as a result of what we've seen here with the threat of tariffs or tariffs being kicked in. So I want to talk a little bit more just about how tariffs are impacting public equities, right, the stock market overall, and how we've maybe factored that into just our allocation with the portfolios a little bit, just overall.
Yeah. So I think Kyle hit the nail on the head there with uncertainty. It's still pretty clear that we don't exactly know what tariffs will be out there and enacted. And we hear an investment seek this duration. Well, let's think about what duration actually is. Even if a tariff is enacted, we actually don't know how long it's going to stay out there. So we don't know how long it's going to affect the macroeconomic backdrop. For example, if someone's manufacturing a widget and they're importing some of those parts from China, right? It's hard for them to act on something that might only be in place for about 2 weeks versus about 2 years. Supply chains really do take a long time to adjust. The other things that are just adding to uncertainty, and we'll dive into them a little bit, but when you think about what's going on with unemployment, right? We've seen that tick up a little bit with what's going on with Doge. That's adding some anxiety out there as well. And then again, when you think about the inflation backdrop, have we actually hit our 2% target? No, we haven't. And if you look at month over month, what CPI has done, it's actually crept up. So with these three main things in play, and markets being priced I would say, to perfection, right, at 23 times forward earnings, with all that uncertainty out there, I mean, this was probably gonna happen. That you'd start getting people getting a little anxious and start heading towards the door, sometimes maybe a little bit prematurely.
Yeah, we would agree with that. When you look at, really the 5 out of the last 6 years, the markets have given excess returns substantially, with the exception of 2022. So, the tariffs certainly, that's the $1 million question. We at First Trust would agree with exactly what you guys said in terms of there is a lot of uncertainty out there. Who are the winners? Who are the losers? The good thing is we do have a little bit of a blueprint for this. This administration, obviously, going back to 2016, but at this point, which products, which countries, what is that percentage? Is this all part of a negotiation tactic, or is this real? I'd say under the last term, a lot of this really was a negotiating tactic. Under this one, that's a little of our concern, is that it will go through and we'll use this as a way to generate revenue moving forward. But with the markets priced where they are, I do think that adds a little bit more anxiety to the situation, certainly.
Yeah, in I think it was 2019, the U.S. The tariffs that we had in place generated $70 billion of revenue for the government, and that was short-lived, and that was pretty light. So hopefully this will generate more revenue that we can apply to other areas to help pay down the debt. And one of the things, as we continue down this path, with the uncertainty, so let me tell you from an economic perspective where we see money flow. So when there's uncertainty in the market, what tends to happen? People pull money out of stocks and they go to T-bills, treasuries, right? Now, when there's a big demand for treasuries, when there's a big demand for something, that'll push the price, that'll push the rates down, the interest rates down, okay? The demand on that. So part of this can be good where at the end of this year, we need to refinance 10 trillion with a T, $10 trillion of debt that we have coming due. And if we can continue to push interest rates down, that's going to save us taxpayers and the government a lot of money in the long run. So it's great that we're seeing those interest rates hopefully come down some. When we're looking at this, I'd say short term, Goldman Sachs, they did an estimate talking about how a 5% hike in tariffs could bring down the earnings per share of each of the S&P 1 to 2%. And if we look at it, if we're looking at 10 to 25% tariff hikes, that ultimately could probably bring down the earnings per share of the S&P down by 2 or 3%. So it's a decent little hit to the S&P, and we're just kind of into this a little bit. So we could see that come down a little bit more. That's a short-term picture on it, right? Long-term, tariffs work when there's a domestic alternative, when there's an alternative to a good here in the U.S., right, to what's overseas. So that goes back to my example of, the maybe Nike and Adidas versus New Balance. Those tariffs work when there's a domestic alternative, when there's a place here that you can purchase those goods. I'm going to walk you through maybe a cycle here, an example of a way that maybe inflation can come down some, and it ties into what I was just talking about, where you take a stock like NVIDIA. So NVIDIA makes chips for a lot of the data centers out there and a lot of the companies that need them. Well, NVIDIA's stock the last couple of years has done really well. So when people are making a lot of money, that gives you extra money to go spend. Well, what's NVIDIA's stock done in this year? Down 25%-ish?
Yeah, I think so.
Somewhere around there. So when that stock pulls back, now there's less cash for people to go spend, and there's a flight to safety. So what that does is it's really, I think the way that maybe this administration is looking at it, they have a little more focus on Main Street versus Wall Street. And so this is probably going to cause, Wall Street to take a half step or full step back here so that Main Street can take a step forward. And I think that's going to help to tame inflation a little bit because people aren't out spending as much. When you look at the we see so many portfolios come in when families aren't clients of ours and they're heavily invested into the Mag 7, Facebook and Microsoft and these companies. And when we see a pullback on that end, it causes you to not spend as much money and be a little more careful on that end. And that helps to bring down inflation a little bit, right? Bring that spending back a little bit.
So maybe a couple of things. When we talk about uncertainty and what markets are doing, we've all heard the term the VIX, right? And that's just looking at implied pricing of options on the S&P 500. And as it skyrockets, it's known as the fear index. So as it goes up, it means people are getting more fearful. Well, there's actually another metric out there, and it's the Core 1M, which actually reads the implied correlation between stocks. And what we're currently seeing is still a mismatch between the two. And really, if this was a major sell-off, you'd see them both move up quite a bit. We haven't necessarily seen that yet. And with stocks like NVIDIA, and this is where we kind of stole the tagline from First Trust. Remember Dave McGarrell last year saying, get wide? Yeah, I'll have you dive into that. But when you look at the concentration at markets, it doesn't really take a lot for people to lose faith in those stocks that are controlling the market. And then it's not, for my engineers in the room, it's not the first derivative that matters in public markets. It's the second derivative. It's just when people start buying less, and less. And then with the advent of leveraged ETFs, once people really see the stock of, say, NVIDIA drop a lot, everyone's heading towards the exit. So not only is NVIDIA falling a lot, but you get the markets as a whole falling quite a bit. So something that we've done, and I think this is something we're getting into, is we got wide.
Yeah, absolutely. And the adage of it works till it doesn't as well. So, at First Trust, looking at the last, especially 2023, so what we look at is just is the market really narrow, super concentrated, or is it much wider? Does the average stock participate in that performance? 2023 was the most narrow market in recent history, at least going back 20 plus years. We thought that in 2023, only 27% of the stocks in the S&P 500 outperformed the S&P 500. So just a very few of those stocks were able to kind of keep pace with the S&P 500. So if you use 50% as your barometer, it was roughly half of that. We thought 2024 was going to be a wider year. The average stock would participate. So instead of, we were right a little bit. So instead of 27% of stocks.
Only a little bit.
Just a little bit. Instead of 27% of stocks outpacing the S&P 500, 28% outpaced it in 2024. But what we look at is previous time periods where the market has been that narrow. It has happened. It tends to go in cycles. The late 90s was a great example of that. It was super narrow for a 4 or 5 year period. What happened in the early 2000s was the market did a total 180 and completely opened up. So the average stock for a 6-year period outpaced the S&P 500. So that is our base case at First Trust for this next cycle. It doesn't tend to just be a 1 or 2 year cycle. It tends to be a 4 or 5 year cycle.
So interpreting that for a second, right? A lot of you, or we see a lot of portfolios where everyone just, buys the Mag 7 when they come in. Those are the portfolios that we see. They're really concentrated. And what we're probably going to see here over the next couple of years during this next cycle is just a much broader market where small cap, mid cap, some alternative investments, all that should do better across the board instead of just those high growth stocks. So, yeah. Moving in, I think, to our second area here that we want to hit on is I want to talk a little bit about how institutions out there have started creating ETFs and ETF investments. So I'm going to explain this real quick. We're all probably familiar with a mutual fund. A mutual fund is a group of stocks. Let's say 100 stocks inside that mutual fund. And what an ETF is, it's very similar. It's a group of stocks inside of a fund, but we've seen a huge move away from mutual funds into ETFs. Mutual funds tend to be very expensive to run, And usually you can get an ETF at a 80-90% discount from a mutual fund. And ETFs, you can move in and out of the market on a daily basis, whereas a mutual fund, you can only move out at the end of the day. So ETFs have become the popular place. So now I just wanted to have you make sure you understood a little bit about what an ETF is. On that end, what we're seeing is that alternative investments have really started popping up in this area. So think of it this way, like picture, the Wall Street suits, what they're doing is they're crashing the alternative investment party. But what they're doing is with these ETFs, these alternative investments that they're creating with private credit and private equity inside of these funds, I think it's like showing up to a party with a watered down bottle of wine. And we're seeing a big trend with these pension funds and endowments, piling into these ETFs. But I think on our end, the name of the game, we do want diversification, but we want to do it at a better level. And I think we're ahead of the curve here at EdgeRock, where we're doing it better. We're not going with that watered down version of an ETF for those private investments. We're going, I think directly to the source, and boring diversification really isn't our style.
Yeah, so I think the kind of the vehicle you're referring to is the evergreen interval fund. So if you think about a typical, what a alternative or private investment looks like, it's typically in a partnership where you have a sponsor, general partner that sits on top, limited partner at the bottom. As an investor, you're in that limited partnership, that limited partner spot, and your capital is locked up for 10 years. Well, with evergreen interval funds, and I think Ryan can opine, as you have VFlex, which is a wonderful vehicle. It gives you instantaneous and continuous access to these funds, but it also gives you quarterly liquidity. So a little bit of the best of both worlds between what it would be truly liquid, like an ETF, versus a limited partnership.
Yeah, absolutely. And, we think the timing of all of this in terms of you look back through previous down cycles and, previous recessions and the type of liquid alternatives, as a way to hedge and buffer yourself and add that level of diversification from a liquid standpoint just wasn't there, right? It was available to endowments, to pensions, to sovereign wealth funds. If you look at the typical asset allocation of, say an endowment, and you think of endowments, there's really kind of two that I think really come to mind, that being Yale and Harvard. Just massive endowments.
Dave Swenson literally wrote the book on it.
Yeah, exactly. And you look at their asset allocation, how much do you think that they had in, true institutional private alternatives? And that number is like 40 to 60%. So a huge weighting. You look at more of our markets, I would say, I know it's different here at EdgeRock, but most investors, it's less than 5, right? So, and you look at the performance of some of these endowments, the Yale endowment for the last 20 years has been down once, versus a typical 60-40 portfolio has been down 5 times over that 20-year period. So finding solutions that I think truly are a third leg of a stool in a liquid format.
Yeah, and the benefit to everyone here is when you own those instruments, not only do you get the illiquidity premium, so the way to think about that is, yes, there's still liquidity to these products. It's a risk that you can't liquidate the next day, so you ought to be paid for that. You're receiving it, but then these assets are marked, not bid like they are with public exchanges, so you don't get this massive market psychology volatility of movement. So if you lose 50% one year, you have to gain 100% back. You don't have to do that with these instruments.
Yeah, that's exactly right. So with the private investments, it's something that we gained access to. It's really started to come on the marketplace here the last couple of years. So in our portfolios, we started allocating 10 to 30% of the portfolios to private investments to help insulate from these times in the market like this, so that your portfolio isn't just shocked and you're not getting eaten up by those big drops in the market. And I think, exactly what Ryan said there, where, you have the endowments that have done this for 20, 30 years, 40 years, and where they have allocated 30, 40% of their portfolios to private investments. And it's really, they've really benefited from that. If you look at Warren Buffett's portfolio at Berkshire, 70% of that portfolio over the years has been made up of private investments. right? And so adding that mix in really helps your portfolio to have something that's not correlated to the market every day, right? So again, going back, I said earlier, the market doesn't like uncertainty, and so much of what we have seen in the last week is some of it is an emotional reaction to what's going on out there, right? And companies that are not tied into the market every day are not traded on the exchanges, they're not being hit because people aren't going in and emotionally selling them, right? A lot of these investments, they're liquid on a quarterly basis, the interval fund structure, and so they're much more stable. And you can count on them better. But if you're going to invest into something, as Rob said, like a private investment, and it's only liquid quarterly, you should get paid for that illiquidity. You should hopefully over time make more money. And that's what we've been able to see over the years with private investments, private equity, private credit, private real estate, private infrastructure, and so forth.
Also real quick, just looking at valuations. So we had mentioned that public market value, probably a little bit lower now, but public market valuations, 20 times next year's earnings, 21 times?
21, 22, yeah.
It's still pretty high. I mean, that is not true in the private space. I mean, I would say valuations on those businesses are much more reasonable. So when you look at us as stewards of your capital and we think about, it's hard for us to eliminate risk in a portfolio, but when we think about what risk do we want to take on? If I'm taking on equity risk, I'd much rather take it on at something like 15 times earnings than 21. And that's what we're finding in the private space.
And I think the quality of the investments that are in that private space is going higher as well, right? If you're a company that is private and you look into the public markets and the scrutiny and the reporting and shareholders, staying private could be a benefit for them, right? There's plenty of money out there in that private space. You don't need to go public. Look at SpaceX. I mean, just the solutions that are out there. Staying private is a great alternative for them.
Yeah, if you look at this chart above me here, if you take all the companies in the United States that make 100 million of revenue coming in the door, 100 million of revenue coming in the door, 85% of those companies are not on the exchanges. You don't have access to them. A lot of great companies out there. And so by going to these private markets, it allows us to get into some of those companies. And a lot of you have heard you've heard a lot of the names, Dell Computer, Fidelity, Mars Candy, Albertsons Grocers.
Databricks.
Yes. So there's a lot of SpaceX. I mean, there are a lot of great, wonderful private companies out there to invest in. And I think another piece here, which we've got a slide for this, is talking about manager selection and how critical that is. And Rob, I'm going to hand that to you to hit on, and how important it is to filter out and choose the investments correctly here, and choosing the right manager is extremely critical.
Yeah, so what Kyle's referring to is when you look in public markets, if you go to, say, a large cap growth manager, the difference between your best and worst large cap growth manager are only going to be about a couple of percent from each other. It's vastly different in private markets. It can be up to 10, 12%, right? Yes. Maybe even more. Oh, he's got it up there. Fancy that. Well, anyways, that's why diligence going into the right sponsor, have these managers done this before? What has been their vintage history? That's why we spend so much time diligencing them. And I know that's what First Trust thinks about when you're placing investments in VFlex.
Absolutely. Yeah, we brought on a family office from Chicago that just had this fantastic technology and this great alternative sleeve, bringing over VFlex and a few other of their different portfolios. Just the research that goes into that. It
makes a difference.
Manager, absolutely.
I mean, it's the difference between a 12% net IRR and maybe getting nothing back.
If you think about this here, if you take a manager on that private equity side, you can see a good manager over time, they're hopefully on the higher end of that rate of return versus a bad manager on the lower end of that rate of return. Think about that dispersion difference. If you're on the lower end, if you have the wrong manager, you're missing out potentially on a lot of rate of return on an annual basis. And over time, that really adds up, and you're going to fall behind. So that's where, I think our team, Pierce as an analyst and Rob, all the time that they take behind the scenes to do the due diligence, to filter through and figure out which private equity, which private credit investments. VFlex is a great option. A lot of the choices that, we bring to the table, we get hit up and between phone calls and emails on a daily basis.
It's miserable. It's unreal.
The stories that Christina has to go through from some of these sales reps that try to get to us on a daily basis. Oh, I know Kyle. Kyle told me I'm his long-lost friend from college, and we were just talking last week, and patch me through right now. Yeah, I mean, it's, the stories that we get every day, they're pretty interesting. But out of all the companies we get 20, 30 a day probably reaching out to our office, and, that's probably about the amount that we have on our platform right now is between the 20, 30 number after a couple of years of this. So I think we really take a lot of time to do our due diligence, find the companies with great track records, great teams, great managers, so that we can deliver that back to you.
Yeah, it's something even in the evergreen interval fund space, when you think about the mechanism that makes that vehicle work, we always want to know who are the teams that have done this in the past and have they been successful at it, which is why you'll always find blue chip managers at EdgeRock.
So let's dive into our last topic here, which is finally, I think, going global with equities. I think with this, it's like, we've been cooking a good burger here for a while. We've been, hanging out with the U.S., but now we're adding in some international spice. We're adding in a little bit to it.
Yeah. So a couple of things there. Again, we were talking about risk, and it's okay, there's a market out there, and we need to go find a good risk-adjusted return for everyone here. Kyle and I and the rest of the team are looking at each other. Do we really want to take S&P 500 risk right now? I think the answer is no. I mean, you always need it in a well-diversified portfolio, but what else is out there that could possibly drive returns? Well, I've said it before, we've been a little bit home biased here at EdgeRock. One is because when you think of the S&P 500, half of those revenues come from overseas. There are a lot of iPhones out there, right? They're all not sold here. So we've been comfortable with saying we get our international exposure through the S&P 500. What we have found as of late, Europe is starting to spend more money on various endeavors. Those managers are starting to buy back more stock. And when we hear buybacks, that's something that's going to buoy the share price at the end of the day, and those valuations are a lot more reasonable. I think another reason, and Ryan, feel free to opine on this, but I think you're seeing a little bit of a rotation. And when you think of developed Europe, I think of value, which is mostly financial and industrial stocks, which are reasonably attractive right now.
No, we would agree with that. And our favorite quote at First Trust is "Math wins." It's a little nerdy, but that is our favorite quote. Math does not win all the time, but math does win over time. And I think there's a reason, you look back over the last 10 years, and maybe there is a reason that the U.S. has dominated, right? In terms of, the math that we're looking at, what really drives markets higher long term is not a news cycle or a crisis, it's earnings. And the earnings in the U.S. have been strong for the last decade. You take a look at the earnings growth, moving forward here, and you are seeing a lot of those European companies look really attractive, and their markets have just not kept up with ours for 10 years. So that bar is so much lower. You look at the bar here, again, when you've got the S&P 500 in the U.S. markets priced for perfection.
You come to find out that maybe things aren't perfect.
That's right. And the other thing I think is pretty interesting too is if you look back over the last 15 years, just the top performing stocks on a calendar year basis, so each year for 15 years, what's interesting and the stat that really surprised me is that on an annual basis, 83% of those stocks are not in the U.S., right? So there are opportunities in the international markets. It's just finding the right manager and EdgeRock really doing their due diligence to find the right manager to go out and find those opportunities. But there are opportunities out there.
Yeah, and again, I think this goes back to what we were just talking about a moment ago, where manager selection really does play a big role in this. So finding the right international opportunities, the right managers is going to play out in the long run.
Yeah, and Kay, I don't know if this is where you want to go next, but how else have we maybe taken away S&P 500 risk from our allocations? One of the things we look at is, well, we can't put all of your money into private enterprises, because then you're going to take on all this illiquidity risk, and when you call us for money, we're not going to be able to raise it. So how else can we decouple from the S&P 500? One of them, and Ryan, I'd love to go into this with you a little bit more. This is a strategy that I found well over a year ago. It's called FTLS, and what it is it's a long-short strategy sponsored by First Trust. You guys run it, and what I mean by long-short is not only do you have long exposure, so when these stocks go up, right, we'll make money off it, but they also have short exposure. So if a certain group of stocks go down, which stocks occasionally do go down, we'll profit off of that as well, and that has been a wonderful holding.
Absolutely, and again, to have that in a liquid format as an ETF, to go along with the interval funds, there are solutions out there that again just really didn't exist, at least in terms of a liquid format in prior years. And the one thing I'll say too, that you talk about international, I think the reason why, as I'm out in the field and doing presentations like this, that international has been so frustrating to a lot of people for a long time, is that when you run profitability screens on the international markets, like our quantitative screens that we run at First Trust, what we're finding is about 60% of the indexes, just the broader based international indexes, are completely unprofitable businesses. So for us as a firm, and I know EdgeRock, you feels the same, it's more about companies than it is about countries. We're not interested in putting a certain amount of assets in certain countries. It's more about just finding the conviction in the right companies.
That's a wonderful point. Good old-fashioned active management and stock picking. Refreshing to maybe see that come back a little bit.
So what that means is, give you a little bit better idea there. You can go buy, let's say, an international fund, right, a mutual fund or an ETF that might hold 2, 3, 4, 500 stocks inside of it. But to Ryan's point, on average, 60% of those companies inside of there don't make money. They're not profitable. So to just go buy an international fund is, I think it's kind of pointless.
Kind of reminds us of small cap, right?
Right.
That's why we go active in that area as well.
That's right. And so let me give you an example. Rather than us going out and buying, let's say, an international fund or a small cap fund that has 500 or 1,000 stocks in it, what we'll do is I want to go find a manager that's managed that area for a long time. So for example, there's a small cap fund that we'll use occasionally. It has 35 stocks in it typically, around there. So what I want is I want a manager that actually can go visit those companies and go choose the right ones, the ones that I think in the long run are profitable, that are doing well and so forth. So to your point, I want a money manager that's got conviction, someone that's going to go out and do that research and go find me those 35 or 50 companies, instead of just anyone can go pick 1,000 small cap stocks.
Not trying to hide in a benchmark.
Yeah. So, I think this is where manager selection, again, I think is another big area, us finding the right fund with the right manager over time. And so far, it's been a good choice. We'll see, there's a lot of uncertainty out there, so we'll see how it continues to play out. But I think Rob and his team making that choice a month ago has really played out well so far. So, anything else to add on that piece? Good? That's perfect. Okay, super. So there you have it. Tariffs are tossing curveballs, and ETFs or alts are crashing the ETF party. And EdgeRock, we're doing adding in a little piece to your portfolio where we're taking you on a world tour and getting around the world on that end. So send us your questions for our next episode of RockTalk, which will be on March 18th. You can send questions to rocktalk@edgerockwwealth.com, and we'll be sure to add those into our next topic there on the 18th. You can also follow us on YouTube, social media, and thanks for your time. We'll talk to you soon.